This is my financial disclaimer so I don't get sued. Good morning, good evening, good whatever time it is you listen to this. I hope you're having a good one. I'm going to be going over the data sets and the SPY technical analysis for September 26, 2025. And with that said, let's go ahead and jump straight into the data. Now for Thursday, September 25th, the data came in pretty hot overall. From the jobless claims coming in cooler, from the initial to the continuing jobless claims. Now, I'm going to address that in a second because I do want to talk about that. Then the durable goods orders came in higher, PCE prices came in higher, the trade good balance came in higher as well. Existing home sales, about the same, still a negative. They had a downward revision for a negative 0.2% compared to the 2% they were expecting. So that's massive. And what was also massive was the 7-year auction today. So we are seeing the bull steepening within the yields. So we're seeing the short end of the curve and the long end of the curve starting to pull together a lot closer, doing the uninversion, where we will eventually have the long end of the curve back having the higher yields, where the short end will have the shorter yields. But the process of the bull steepening does cause the yields to rise, as you know, it's as the name implies, bull steepening. It's causing a bullishness to the yields, but it's not in the way that it's continued bullishness. This is how the yields correct essentially. I'll have to explain it more in another video. I'm not feeling too well tonight, as always. I apologize. Anyway, so let's go over the jobless claims. So one thing we do know about the jobless claims is that the unemployment rate has been consistently going higher. The jobless claims, even though we're seeing a downward tick right now, we know that the hiring has still been pretty much closed off across the board. So what does that mean? Does that mean that these people are getting off their unemployment claims because they're just not able to enter into the workforce? And from that point, just they're not entering back into the workforce right now. They're either trying to, um, do, quote unquote side hustles or smaller jobs, online jobs, things like that to make profit when they're not able to find work. So I know there's a ton of people out there currently in that position, and I do think that's why we're seeing basically the downside in the continuing jobless claims. I don't think it's the fact that these people are getting hired. It's the fact that there's just no jobs available. So people aren't getting hired right now. And if they're not getting hired, then they have to be falling off their unemployment. Their unemployment benefits anyway. So with that said, I do expect the jobless claims to pick back up pretty soon. This GDP print and everything, I fully expect and anticipate this to be revised downward. Almost every single one of these data sets I expect downward revisions within. Yeah, other than the jobless claims and everything, I expect upward revisions in that. So for Friday, let's go over the 26th. So the 26th, we have the very important PCE data in the morning. Now, the PCE data is the Personal Consumption Expenditure Index. It basically tracks, how much the average person is having to spend in their life to actually, survive and have a decent life. I looked over the expectations currently, and pretty much everything across the board right now throughout these data sets are expecting hotter prints. Um, so these numbers in the forecasted aren't correct. They've been actually revised higher. So the expectation for tomorrow should be that the PCE should come in very hot. The inflation expectations should be coming in pretty hot. Um, yeah, just overall across the board, we should be seeing some strong data tomorrow, which with how the market works, strong data usually leads to bearish days because strong data means no rate cuts. And we even heard that from one of the Fed members today, and I don't remember which Fed member it was. It might have been Daly or Williams, one of them. But they said that essentially the Fed cannot continue the stance of being in rate cuts if, you know, there's the very real potential that inflation is going to, get out of whack again and continue higher. And you have to remember, the Fed only has a few tools to uh, help influence where inflation is going, and that's either modifying the interest rates, which is the federal funds rate. They can either cut that, pause that, or hike it. If they're cutting, that's causing the system to uh, be less constrictive, where if they're hiking, it puts a very large restriction or constriction on everything. Uh, then the Fed can also buy or sell securities, which means that they can either do quantitative tightening or quantitative easing. Those are the only two tools that the Fed has. Now, for the Fed to combat inflation, if we're actually going to have inflation upticking, I don't think that's the case. I think that a lot of this data is going to get downward revised very, very soon here. Um, but with that said, besides what my bias might be, if we're going to see inflation ticking back up, then the Fed has to stop cutting. Okay. The Fed basically cannot cut into inflation. Um, that's the tool they use to help the system be less constrictive. So yeah, there's just zero chance of them cutting if this inflation is actually really coming back. And I think that's what the Fed is being very cautious about right now, is that they're between two different stances, and that's that the labor market is potentially going to be dropping off a cliff. And if that does happen, they have to cut rates into that basically massive cuts. Those are the type of cuts where you get, the 7,500 basis point cuts randomly throughout the, basically the overnight cut type of situation. Now, the other side of the coin is that inflation requires actually keeping a neutral stance or even tightening the stance more, meaning hiking the rates. Now, it's very difficult for the Fed to be in between those two. And so right now they're just really trying to hold a very neutral stance until the data is solidified enough that they can really say one way or another that we have to put our cards on fighting inflation, or we have to put our cards on fighting a failing labor market. One of those has to be their target, and currently they're trying to target both. And it's working. It's just they have to do it in a very careful way. For example, they did the rate cut, but while they did the rate cut, they've been also doing quantitative tightening, which is, selling securities. And those are kind of opposite sides of the coin. Selling securities doesn't really help reduce the yields. It kind of helps burn out the the money in the system and pull the money from the system so that the yields can eventually drop. Uh, Buying of treasuries is usually to um, help stimulate the dollar and put money back into the system. So anyway, I'll stop rambling about that, but I just think it's very interesting where the market, the economy, the Fed, and everybody is kind of sitting right now because it's a very massive. It's basically two massive battles that they have to fight, and it's either going to be the battle of you know the ocean or the battle of land and air or whatever. They can't use the boats on land, they can't use the airplanes in the water. So um yeah, it's interesting to see. Now, again, just to quickly go over it, whenever the Fed cuts, and this is just a very, very historical trend across the board, is that whenever the Fed cuts, the interest rates do go back up, or not the interest rates, the treasury yields do go back up very, very slightly, and generally we will see very hot data coming out during that period. I don't know why this happens, but it just always seems to happen. So just keep that in mind as we see the data come out over the next few weeks. But I do expect a lot of this data to be downward revised, especially the GDP numbers and everything. Um, Now, one thing about the GDP is that the GDP can be stimulated by the tariffs, and I know the tariffs have been pulling in quite a bit. Now, I don't think in the end that's going to matter because usually the revision will add in the I can't think of the word right now. Basically the inflows and outflows throughout the exports and imports. Um, Once those hit and everything, and those have still been massively in the negative. So I don't think this GDP number is fully correct, but we'll see. So for tomorrow, again, 8:30 a.m., very, very key data coming out. It's anticipated to come in higher. And for the 10 a.m. data, that's very likely going to come in hotter as well. And if this data does come in hotter, then the equities very, very likely will suffer quite a bit. This is the type of data that you don't want to come in hotter. Yeah, so potentially we could be in for a really, really, really large selling day tomorrow. Kind of interesting. But yeah. If you're enjoying this, please check out my Patreon. For just $1 a month, you can join our community chat and access our tools like the Unusual Whale Spot and our own personal GEX and DEX market positioning. My $12.99 premium tier gives access to my personal trades, 2 live classes a week, which are on Wednesdays and Sundays, and direct support from myself. The links to join are below, but you can also join through patreon.com/wooksy. Thank you for supporting me to help you build skills for a lifetime. And quickly going over the technical analysis, as always, let's go into our daily time frame. Let's ensure our moving averages and Bollinger Bands are turned on. And let's go over it. Now, the market closed today at 658.05, and the 5 mile is currently at 662.58, so it will be pulling down quite a bit tomorrow. I don't have the exact amount off the top of my head. I'm going to assume it's going to be around that 660, 50-ish. So assuming it's that 660, 50 range, the upper bounds of the 5 mile will be at 662.50, basically where the 5 mile is currently, and the lower bounds of the 5 mile will be at 658.50. Okay. Now, with that said, we had a very, very large selling day. I don't want to call it a large selling day. This wasn't a large selling day at all. It just looks like that in retrospect because we never get selling anymore. So we started this week pretty strong. basically coming out of the upper Bollinger day 2. And from that, we tested the upper bounds of the 5 mile, then the lower bounds of the 5 mile, and from the lower bounds of the 5 mile, so far, we have pulled down to the upper bounds of the 20 mile. Now, it is very, very key to understand here that this was not a 20 mile test. Okay, this was by no means a 20 mile test. We tagged the upper bounds just barely. No, we didn't even tag the upper bounds of the 20 mile. Excuse me. The 20 mile is currently at 653.45. So, the low we got today was 6. Okay, yeah, we did touch the upper bounds of the 20 mile. But we did not touch the 20 mile itself. We did not go through the 20 mile. We did not touch the lower bounds of the 20 mile. So, was this a 20 mile test? Not really. Is this a 20 mile bounce? Not really. It can be, but I don't really think so. Um, let's see. The upper bound or the upper Bollinger is currently at 669.75. So if we do see all of this weight basically bought back up, we're headed to the 673-ish range pretty quickly. This would be a pretty quick move from here. Because remember, after the 5 mile is tested, we either head to the 20 mile or we head to the upper Bollinger generally. Now, with today not really securing that 20 mile, it just puts the direction towards it, but it didn't really secure the level. Okay, so we still have it open that we can head all the way back up to test the, or go to the upper Bollinger at this point, potentially. So just keep that in mind. It's a little weird when you have such a large move on the day, because if you don't secure that level, then it really allows a lot of this selling weight to basically just be bought right back up. All they have to do at this point is just do another 5 mile test from here, and they have all the liquidity they need to head straight up to the, that 673 range, and from there, basically another upper Bollinger move into the higher high of the day 2. But I still expect the 20 mile to be pushed into very likely tomorrow with tomorrow's data. And going over the 4-hour time frame really quick. Now, I do want to pull up the drawings and it might pull up a lot of random stuff. Hold on. Okay, so this is all playing out very, very well so far. And just going out through the week, we've been discussing this head and shoulders. It built the head finally. From that head, we were looking for the right shoulder to form. The right shoulder formed, and from that formation, we saw the move down. Now, we were looking for a inverse cup to form on this downside. Okay. Hold on, let me just get the drawing tool out. What I really want to emphasize here is that there is a bit of space in between where the actual bottom of the inverse cup should be. So is this a completed inverse cup? No, it's not. By my standards of doing structures and everything, it's not complete. We would need to see that full range taken, and from that range, that's where you would look for bullish structure. Bullish structure leads into the upside, and then you obviously look for the bearish structure. And that's how you get the move back down. Let's go ahead and make these purple so that we know what we're looking at here. Actually, I'm going to make them blue. For my colorblind viewers, I apologize. I love you guys though. Anyway, so again, look for the bottom of this inverse cup to close if they're actually going to take the range. So if they're going to continue the bearishness here, we have a massive move down still. We have a full, basically $6 move downward, if not further. But if the market does not take this as a bearish move to, push more liquidity down, then all the bulls need to do, and I talked about this in last night's video, but all they have to do is build some of this into some bullish structure, like that inverse head and shoulders right there, fill out that right shoulder, and head right back up. Okay, and that's really not that far away. It looks like it in retrospect, but it's not. Um, that's a move that can happen within 2 or 3 days tops. So just be aware of that. Many are going to assume that upside from here is that inverse cup that's being built, but it's not. So if we do have upside from here, if we see liquidity building in here and start heading upward, then that should be a very good signal that we're going to be heading back up again. Okay. This bear structure has not been completed. It's very, 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 very crucial that it is fully completed, and from the completion of the structure that we see bullish structure at the bottom. Okay, that is how every single inverse cup works. This is how every single cup works on the, the bullish side. If this was a bullish cup heading upward, you'd look for bearish structure, head downward, look for bullish structure to head upward. Okay, so same thing applies here. Now, with that said, the expectation for tomorrow should be either we're going to push into the 20 mile or we're going to head back up to the 5 mile. Really, there shouldn't be an in-between. I'd be very, very surprised if we don't secure one of those levels tomorrow. Now, with that said, while this isn't an inverse cup yet, this can still form this right shoulder right here. Okay, this can still form this larger head and shoulders to push downward. So we can head upward and then back down. Okay, now if we start heading upward, you're really looking for that 661. If they start pushing too much further above that, then I would say that that's really invalidating this very large head and shoulders. Okay. Because that really starts bringing the shoulder up quite a bit. And while that can lead to selling, for example, we head back up to the 5 mile, retest the 5 mile and have a rejection back down to the 20 mile, that can cause that right shoulder to pull back up quite a bit and head back down. Now, I don't really anticipate that because remember, the 5 mile is basically going to be at that 660 50 range, which means that if we're going to see some upward buying, then that will push the 5 mile basically that 661 20-ish range. So yeah, I wouldn't really be trying to short if this pushes into that 662. I really think that would be the ticket right there. So yeah, that's kind of the expectation over the next few days. And with tomorrow's data sets just being forecasted to come in quite hot, I do expect us to really pull down and finish out this cup. From this cup, make sure that you set up calls. Gonna be very, very, very clear about that. Doesn't matter if you're like the biggest bear in the world, you set up calls on this 20 mile. Okay, you do not ignore that. Because the potential to head right back up to this 675 plus ranges is massive. Okay, massive, massive. Remember, we're in a super, super, super bullish channel. Okay, it doesn't matter how bearish things look, as long as this channel's holding, then buy the dip, essentially. And as a bear right now, I hate to say that, but it's like anytime you get even remotely close to the bottom of this channel, you have to buy long calls into it. And the potential is that you buy long calls into this and we break the channel. Well, sure, you lose some money, but you protect a lot. Yeah, it's just it's something you really have to do. Heading towards the bottom of of these buying channels like this is just massive call buying territory. You know, for example, the last few times we could have bought calls, which we all did, it's just a lot of us sold them early. We really have to understand that when you're buying calls on the 20 mall, you know, buy straddles, which means that you're going for 1 to 3 months out. You know, I would not go shorter than that. 1 to 3 months out. You want the call and the put to essentially be the exact same weight. And you can do that through the delta. So you can check the actual deltas within the contracts. If they're the same deltas, then they're going to hold the same weight temporarily. Or you can try to buy the same strike. So for example, if we're at this 658 range, then you just buy a 658 call and 658 put for, you know, the 1 to 3 months out. And you allow those to move all the way back up to either the 5 mall or the upper Bollinger. And what I mean by that is if you have the puts, for example, then you would want to try to close those puts out on the 5 mall retest and acceptance, okay, towards that upside. However, if you have the call and we break this channel, then that's telling you, okay, this is starting to form a selling channel. We need to potentially, you know, get a different straight call set up. Okay. So yeah, that's how you really need to trade this over the next X amount of weeks. Okay, we don't know how far this channel goes up. We don't know how much longer the rally will continue. Potentially this is going to be the structure that finally breaks this massive buying channel. I don't know. My crystal ball is in storage right now, so I apologize for that. But with that said, everybody should really have the expectations for not just tomorrow, but for the next week, and not even looking at next week's data. Either we're going to push the 20 mall and start heading down, or we're going to buy all this weight back up and push the upper Bollinger again. So lots of money to be made. Just play it smart, trade it level by level, and I know not everybody trades by the moving averages. That's totally okay. But whatever your trading style is, don't cut your contracts early, because some of us had some massive contracts during this entire rally, especially at the very beginning. I know that I even have the Discord post about it, but right at the very, very, very bottom of this dip, we had everybody in the group who had spy leaps, S S OXL leaps, TQQQ leaps. I mean, I had, you know, before the time, I had 12 or 16 600 calls for, I want to say it was August 16th or 25th, something like that. And I cut those basically at the 590 range because I thought that that was when this large cup was going to finally break. Now, that wasn't the case. Those calls could have easily been worth like tons and tons and tons more. But it is what it is, but it's a learning example or a learning lesson, you know? When you hit the bottom of a buying channel, buy long calls and you wait for the upper Bollinger. And you just continue that cycle until the channel breaks. So that's it for tonight's video. I hope everyone has a great weekend. I appreciate all the nice comments and everything everyone's been leaving me over my last few videos. I know I've been sounding sad and depressed and everything. Um, Thank you. I appreciate you all from the bottom of my heart. Uh, it really means a lot to me. So thank you, thank you, thank you. Um, with that said, I'm seeing a lot of doctors soon. I should have some results on, some sort of remedy to whatever is causing my just ailments across the board. So I'm looking forward to that. Besides that, I hope everyone has a great weekend. I hope you have a great trading day tomorrow. And I think that's it. I will talk to you next week. See you all in Sunday's video. Take care.